Have you ever wondered, should I invest in mutual funds or should I buy stocks? If you're a beginner, this question can feel overwhelming. Some people say stocks can make you rich. Others insist mutual funds are much safer. So, who's actually right? The truth is, both can help you build wealth. But choosing the wrong one for your experience, personality, and financial goals could cost you years of progress. In today's video, we're going to compare mutual funds and stocks in the simplest way possible. We'll cover what they are, how they work, their pros and cons, risk levels, return potential, real-life examples, and finally, which one is actually better for beginners in 2026? Whether you're planning to invest $100 or $100,000, by the end of this video, you'll know exactly where to start. So let's begin. What are stocks? Let's start with stocks. Imagine your favorite company. Maybe it's Apple, Microsoft, Tesla, Nvidia, or any successful company. These businesses are divided into millions or even billions of small ownership pieces. Each piece is called a stock or share. When you buy one share, you become a tiny owner of that company. That means if the company grows, your investment can grow too. But if the company struggles, your investment may lose value. For example, suppose you buy shares worth $1,000. If the company's stock price rises by 20%, your investment becomes $1,000. But if the stock falls by 20%, your investment drops to $800. That's how stock investing works. Simple, but not always easy. Why people love stocks? Stocks have created many millionaires. Why? Because successful companies often grow for years. Imagine someone invested in companies like Apple or Amazon decades ago. Their investment multiplied many times. Stocks offer high growth potential, ownership in businesses, dividend income from some companies, and complete control over what you buy and sell. If you understand businesses, stocks can be incredibly rewarding. But there's another side. The biggest risks of stocks. Individual stocks can be unpredictable. One bad earnings report, a new competitor, economic recession, political events, or global crises can send prices falling overnight. Imagine investing all your savings into one company and then it suddenly drops 40%. Many beginners panic. They sell at the worst possible time. That's one of the biggest mistakes new investors make. Another challenge? Choosing the right company isn't easy. You need to understand financial statements, company management, industry trends, competition, valuation, future growth. That's a lot for someone who's just starting. What are mutual funds? Now let's talk about mutual funds. Instead of buying one company, imagine hundreds or even thousands of investors putting their money into one large investment pool. A professional fund manager then invests that money across many companies. Instead of owning one stock, you might indirectly own 50, 100, or even 500 companies. That's called diversification. Think of it like this. Buying one stock is like putting all your eggs in one basket. Buying a mutual fund is like spreading your eggs across many baskets. If one company performs badly, others may perform well. This helps reduce risk. How mutual funds work? Let's use an example. Suppose you invest $1,000 into a mutual fund. The fund manager may invest that money into technology companies, banks, healthcare, energy, consumer goods, and many other sectors. If one sector struggles, another might grow. This balance helps reduce sharp losses. The goal isn't usually to beat every stock. The goal is to steadily grow your wealth over time. Types of mutual funds. Not all mutual funds are the same. There are several types. Equity funds mostly invest in stocks. Higher growth, higher risk. Debt funds invest mainly in bonds and fixed income securities. Usually lower risk, lower returns. Hybrid funds mix stocks and bonds. Balanced risk, balanced returns. Index funds. These simply follow a market index, such as the S&P 500 or other major stock market indexes. Since there's less active management, fees are often lower. Many financial experts recommend index funds for beginners. Stocks versus mutual funds. Now let's compare them side by side. Ownership stocks. You directly own shares of a company. Mutual funds. You own units of a professionally managed investment portfolio. Risk stocks. Higher risk. One bad company can hurt your portfolio. Mutual funds. Lower risk because investments are diversified. Return stocks can generate very high returns, but they can also produce large losses. Mutual funds generally provide more stable long-term growth. Knowledge required stocks require research. You need to study businesses. Mutual funds require much less expertise. Professionals manage the investments for you. Time commitment stock investors often spend hours researching. Mutual fund investors can invest regularly with very little maintenance. Diversification. Buying enough individual stocks to diversify properly can require significant capital. A mutual fund gives you instant diversification, even with a small investment. Which one makes more money? This is the question everyone asks. Which one earns more? The honest answer is, it depends. An experienced investor who consistently picks winning companies may outperform mutual funds. But most beginners struggle to consistently beat the market. Many studies have shown that over long periods, a large number of professional investors fail to outperform broad market indexes after fees. That's why many long-term investors prefer low-cost index funds. The goal isn't chasing the highest return every year. The goal is building wealth consistently over decades. Real-life example. Let's compare two friends. Alex invests $500 every month into individual stocks. Jamie invests the same amount every month into a diversified index fund. Alex spends hours researching companies. Sometimes he wins. Sometimes he loses. Jamie simply keeps investing every month. After many years, Jamie may achieve excellent long-term returns with far less stress. Consistency often beats excitement. Common mistakes. Beginners make, many new investors make these mistakes. Buying stocks based on social media hype. Trying to get rich overnight. Panic selling during market crashes. Investing without research. Putting all their money into one company. Ignoring diversification. Trying to time the market perfectly. These mistakes can seriously hurt long-term returns. Which one should beginners choose? So, if you're completely new to investing, mutual funds, especially diversified index funds, are usually the easier and safer starting point. They offer professional management, diversification, lower stress, simple investing, long-term wealth creation. Once you've gained knowledge and confidence, you can gradually explore individual stocks if you're interested. Many experienced investors actually combine both. They keep most of their money in diversified mutual funds and invest a smaller portion in carefully selected stocks. This strategy provides both stability and growth potential. Remember, investing isn't about getting rich overnight. It's about making smart decisions consistently. The earlier you start, the more time your money has to grow through the power of compounding. Whether you choose mutual funds, stocks, or a combination of both, the most important step is simply getting started and staying invested for the long term. If you found this video helpful, give it a thumbs up. Subscribe to the channel for more easy-to-understand videos on investing, personal finance, and wealth building. And in the comments, tell us, are you investing in mutual funds, stocks, or both? We'd love to hear your investing journey. Thanks for watching, and we'll see you in the next video.